Welcome to the Ironworth Trading Show. First of all, I want to thank you for tuning in. If you are watching the replay, thank you for watching the replay, first of all. And if you are here live tonight, thank you. I appreciate you for tuning in. What's up, Ms. L? How you doing? Pretty late tonight, I know. But y'all know how we do in the night shift. It's the graveyard shift, baby. Right? They say the early bird gets the worm, but we rarely get sleep, right? All right. What do we got? So as y'all know, we got this the S&P 500 returns. We're gonna be looking at the S&P 500 returns after Fed cuts and how we are at the pretty much near all-time highs right now. Excuse me. So I'm gonna let a few people come on in. Before I get the show started, because it's gonna be a good show tonight. It's gonna be a good show tonight. I should have went ahead and went live earlier, but it's fine. Everything happens for a reason. That means whoever I was meant to show the live to tonight, they wasn't gonna be on if I had to went on earlier. So that's how you know everything happened for a reason. Everything happens for a reason. That's why, gonna give it a earlier. So that's how you know everything happened for a reason. Everything happens for a reason. That's why, gonna give it a few more seconds and give that specific person time to come on in. QQQ prediction period. I got a whole market prediction for you, Lencho. Real talk. Let me get a few more people in here, because every time I get started, they come in, they miss the beginning, and I got a tendency to start over if they do. I don't want to start and then 400 people come in and I got to restart. Now, I'm not going to wait on 400 people, but I do need the number to get up a few more than 4. So tap the screen for me. Help me push the live out. You guys, when you come in my live and you the first top 10, I need y'all to help me get the other 100 in just by tapping the screen. That'll push the algorithm out. It'll push the live out to a larger audience. So thank you, and I appreciate you for helping me do that. All right. But yeah, we'll go ahead and get the show on the road with just y'all, since y'all tapped in, though. How about that? I value y'all insight, so I value y'all audience. My first topic is going to definitely be about how the market reacts to these Fed cuts, historically speaking. That's the topic. That is the topic. So, where do we start at? Yeah, this is it right here. This is a SPY. All right. Excuse me, y'all. Sorry. Good evening, everyone. Good evening. Welcome back to the stream. All right, so like I said, tonight we diving into something that is both historical and extremely relevant. All right, extremely important that we talk about this, because this is where we are in the stock market right now. The Federal Reserve just made some moves. If y'all don't know, they cut the interest rates, and the S&P 500, that's our main benchmark for the U.S. stock market. That's how we pretty much can pay attention to what's going on in the market overall. It's by checking the S&P 500, and we are looking at that right now. This is SPY. Okay, and it pretty much, it's like the SPX, but this is the little brother. SPY is SPX little brother, but it's pretty much the S&P 500, which is a benchmark for the U.S. stock market, okay? Right now, we are sitting right near an all-time high. As y'all can see, it's in an uptrend. Somebody says, uh-oh, that doesn't look good. Well, I don't think it necessarily looks bad, Lencho, but I'll tell you what I mean, basically. Now, for a lot of people, like, that sounds scary. Like Lencho said, that don't look good. People be like, wait a minute. So the Fed is cutting rates and the market is at a record high. Don't that mean we topping out, right? Ain't that like a signal that trouble is coming? That's what a lot of people like to think, right? We're gonna look at it from both areas. Because we're gonna make money either way. We're gonna make money in either direction, ladies and gentlemen. We got a plan A, we got a plan B, and we got a plan. All right, so not necessarily a bad signal, And tonight I'm gonna show you the actual history behind moments just like this one and what is meant for the stock market in the past. Now, spoiler alert, before y'all, tune in and get all happy and shit, the story is a lot more bullish than you think. For real. And for those that don't know, bullish means when you think the price, bullish is people that think the stock market is going up. Bears think the stock market is going down. All right, if you think it's about to go down, you are bearish. If you think it's going up, you are bullish. We are going to spend the rest of this show really unpacking this. We're going to look at the historical data. We're going to look at examples going back all the way to the 1980s. We're going to talk about why this pattern happens, right? We're going to talk about why this shit happened. And most importantly, what lessons can we take away right now, right? In 2025 going into 2026. Somebody says, are we dropping tickets and you're analyzing? Nah, Hedgie. No, sir, Hedgie. We're not doing that. No, Hedgie, we're not. Not right now. Not unless you stay to the end of the show, okay? You guys stay to the end of the show. You can drop a ticker and I will evaluate. I'll give you an analysis at the end of the show. You got to stay with me though. You got to hit the follow button if in case you don't want to last that long. That way you can come in on another night and I do things like that. But tonight we are talking about the S&P 500 returns after Fed cuts near all-time highs right now at the market. The crowd laughed at me. No doubt, Hedgie. What time frame are your candles? This is a 4-hour chart. Okay, this is a 4-hour chart. But yeah, so I'm gonna go ahead and start with the show, you guys. I just wanted to tell you what the show was going to be about before I do have a couple of picks though. For those that can't wait till the end of the show, this was one of my picks that I was going to show y'all about. Record. If you don't know about Record, Record Systems is engaged in developing and implementing roadway intelligence systems using artificial intelligence, enabled computer vision, and machine learning. This is the future of traffic control. All right, I think that this is a good time to get in, and I'm not the only one thinking that. This is not financial advice. Nothing in my show is financial advice. I repeat, for the record, let the record show, this is not financial advice. This is for educational purposes only. This is for educational purposes and entertainment purposes as well, because I want y'all to have fun. Now, it's a strong buy signal on it, right? REKR is the ticker symbol. And we already know about how good Open did, right? We've been talking about Open since it was under $3, right? And then I talked about it a shit ton more at $5. And then we talked about it more when it dipped. When it reached $8 and dipped from there, we talked about it. Now we at $10 and we still gonna talk about it because I don't think Open is done growing. But I'm not gonna talk about it right now. That's not what the topic is. And Lyft just broke above that area of resistance at $18.53 and went kind of crazy earlier today. But it's still a good time to buy Lyft. That's not financial advice. I'm just saying for educational purposes only, right? And what else I got before I get on with the show? Oh, ELF, ladies and gentlemen, ELF. Can anybody tell me what pattern this is? This is a chart pattern. Majority of stock right now are overvalued. What up, Dino? Can anybody tell me what pattern you see on this right now? Drop a W in the chat if you would like for me to tell you what pattern this is and how to trade it. Close. I guess you can say that TUI. I don't know how to pronounce your name, Tui. Reverse head and shoulders, Lincho. Lincho got the answer right, ladies and gentlemen. Inverted head and shoulders. That's right. Inverse head and shoulders, you guys. Reverse mixed with inverse head and shoulders pattern. The good though, y'all did very good at spotting that. Do you guys now on an inverse head and shoulder? Do you buy a call or a put? See if y'all been paying attention in class. Bullish, asked Dino. Yes, this is a bullish signal. Do you buy a call or a put? You buy a call. This is what an inverse head and shoulders look like. Do you guys see the pattern? Do you see it for me? Put a W in the chat if you see it. Only people who can't see it are the ones who used to try, when they was kids, they used to try to put the circle block inside the triangle hole. There was no circle block, face eye. So, yeah, but you know what I mean. The cylinder. They used to try to take the cylinder block and slide it into the triangle hole. And they used to try to take the triangle block and slide it into the fucking circle hole. You feel me? The ones who don't see the pattern, if you can't see this pattern, the teacher used to ask you what comes after 3, 6, 9, and you would say 10. Okay? You have to know how to spot the patterns, ladies and gentlemen. If you are new to the show, please hit the follow button. I would highly appreciate it. And while I'm yapping, I need y'all tapping. But no, this is not a short situation, Nick. This is not a short situation. Do we need to see this at 5, 10, and 15-minute candle marks? Han, what you can do is you can go down to a smaller time frame to find a better entry. Yeah, but there are also other technical aspects to consider. There are always other technical aspects to consider, Blurro Vision, other than finding patterns. Yes, you are right. You are correct, 100%. You want to look for other areas of confluence. You need other things to point that this is going in that direction. And yeah, but you can trade off price action alone, though. You can. It's like trading with one eye closed, though. But you can. It has been done. It can be done. You know, there aren't any fair value gaps. No, this is not about fair value gaps right now. This is just solely about, I'm just really talking about spotting the pattern. Because all the other shit wouldn't even matter if you can't even spot the pattern first. But that's not the topic of the show. All right, I just wanted to make sure I got that part out the way, because I know a lot of you guys don't have a long attention span. But this is what we're talking about tonight. Yeah, this is what we're talking about tonight. The S&P 500 returns after Fed cuts within 2% of an all-time high. Now, you should be able to zoom in on this, but I do have other presentations. But we'll just get on with the show, right? I'm gonna need y'all to go ahead and grab your notes, grab your coffee, your drink, your tea, your popcorn, or whatever, because this about to be good. So we're gonna talk about what y'all looking at right now. Let's start with the chart that's driving tonight's discussion, right? This chart tracks the S&P 500 returns after Federal Reserve cut interest rates while the market was in 2% of an all-time high. All right, let me see what y'all are talking about. I know this is an ugly ass chart. Let me try to find a better example. I think this one will do for now. This will do for now. This condition is important to pay attention to, y'all, because normally when the Fed cuts rates, it's during times of weakness. But we not in times of weakness right now. But the economy is slowing. We got unemployment rising, all right? Maybe we in a recession, maybe. But in those cases, the market is not anywhere near an all-time high. So no, we not in a fucking, the unemployment rate is not rising. We are not in a recession. You know what I'm saying? The economy is not slowing. All of those things aren't true. If those things were true, then whenever they cut rates, you feel me? That's a downtime of weakness, but we're not in that right now. This chart isolates only those times when the Fed cuts rates while the market was already strong. And this the kicker. Every single time since 1980, the market was higher 1 year later. I don't think y'all understand. What up, MLB? I don't think y'all understand like what that means. You feel me? I don't think y'all understand what that means. This chart isolates only the times when the Fed cuts rates while the market was already strong. And every single time since 1980, the market was higher 1 year later. That's 100% of the fucking time. Let me say that again. In all 18 instances since 1980, the S&P 500 ended up higher 1 year later when the Fed cut rates near a market high. That's an incredibly powerful fucking pattern to try to pay. That's like flipping a coin 18 times and 18 times it lands on heads. That's the odds of the market going in a higher direction. And basically, I'm saying something like that, Keisha. I'm not saying buy or sell. This is not financial advice. I'm just giving you historical data from you know, historically speaking, and you can kind of make your own educated investment plan from there. But what I'm saying is, in all 18 instances since 1980, the S&P ended up higher. SPY ended up higher 1 year later when the Fed cut rates nearing market high like they just did right now. So in the short term, over the next 6 months, the success rate isn't quite as perfect. About 73% of the time, the market was higher after 6 months. Hold on, let me read some of these comments. But would you say this is slightly different as we have other factors affecting rate cuts? Well, blurro vision, every year there was. Every year there was something different affecting that, you know. There was something different every year. Let me read the comments a bit. What up, ladies and gentlemen? How y'all doing? Thank you for joining the show. Y'all know how it go. While I'm yapping, I need y'all tapping. Y'all know how it go. All right, so yeah, like I was saying. All right, so 73% of the time, the market was higher after 6 months. But even with that, the 1 year track record is absolutely flawless. I be trying not to curse as much, but it's absolutely flawless. It's absolutely fucking flawless. I had to get that out. I'm sorry. So the average return after 1 year, about 14%. The median return, about 10%. Both of those numbers are stronger than the historical average annual return for the whole stock market in general, which is usually around 8 to 10%. So history tells us that these Fed cuts near market highs don't signal the end of a bull market. It does not signal the end of a bull market. In fact, they usually signal the start of another strong leg higher. Hey, the power of execution is real. Just because y'all tapped in on this live, you in the right place at the right time. All right, that's how the algorithm is looking out for you. The fact that I came across your For You page, and if you already following me, that means we done already connected, and you already know how it go. You feel me? You done already your trading and already changed since you became an Ironworth trader. Y'all know how it go. I done did the research, and I made sure to come with the facts tonight. Can I ask, in terms of economy, when rate cuts happen, does the economy improve? That's kind of what we speaking on tonight. That's where I'm about to get. That's where I'm getting at. That is where I'm getting at. I just wanted to make sure y'all can see this chart is just, TikTok does a horrible job. It butchers the hell out of my charts when I try to do my slideshows for my courses and stuff, and I bring it over to TikTok. It butchers it. It zoom all the way in or all the way out. It's crazy. But yeah, y'all should be able to zoom in on that on these pictures. But anyways, history tells us that this don't signal the end of a bull run or a bull market, that is really about to go up more. Okay, so does that surprise you? Do y'all think what you thought it was going to be a bearish moment? Did you expect to hear me say that it's been 100%? I bet y'all didn't expect me to hear me say that it's been 100% track record, because you asking me, is it about to keep going up or keep going down? Should you buy, or what about now? Is shit different, bro? Did you not hear me say 18 times in the past since 1980 this shit done the same thing? So if I flip a coin 18 times and it land on head 18 times, I mean, shit, I know you want to say it's about to land on tails, but come on now. You done been wrong 18 times in a row now. I know, you know, one of them, don't be one of them people that's like, you feel me, like the coin then flipped literally on the same spot and you just want to go against the grain. Like, you just want to go against the grain. You don't want to go against the grain, man. Trade with the trend. Trade with the trend. But yeah. You wasn't expecting a strong market response. Not gonna lie. I know that's right, Lencho. I know that's right. Thank you for keeping it a buck. But let's talk about why this pattern makes sense. We're gonna talk about why it makes sense. Why would the Fed cutting rates at an all-time high lead to this shit keep going up? Why would it lead to a stronger bull market? Why would it lead to continuing the strength instead of weakness beginning? Well, the answer has to do with the combination of two things. The way we fucking think market psychology, and economic fundamentals. All right, economic fundamentals. Because somebody did ask, well, what about now? Because the economy is different. So those two things are the main. That's the main reason why it's about to keep going up. Hold on. I'm gonna go back to my chart. Somebody said, made money with you today with Rocket Lab. Filthy McNasty. Thank you. That's what I like to hear. Thank you for keeping it a buck and being honest and coming back to that's all I want to know, Filthy McNasty. You feel me? Keep up the great work. I love to see people come in here making money and taking advantage. And you got the power of execution in you. You feel me? You gonna execute. That's why I keep it coming. You who I do it for. Everybody, big shout out to Filthy McNasty. I gotta keep saying that name. I don't know why you named yourself that, dude, but I'm done talking about it. Look now, check this out. So when the Fed cuts rates, borrowing gets cheaper. We just talked about this yesterday. Businesses can take loans at lower cost. That means they can expand operations, they can hire more employees, and they invest in new projects. Consumers can borrow more affordably too. Okay, y'all can go and borrow money too at a cheaper price. Do you go live during the market? In the community, in the Cord, I do. In the DC, if you know what I mean. Hit the link in the bio. And I also do on I do other places. I can't say here because I don't want TikTok to misunderstand me and think that I'm trying to get anyone to leave their platform. But I have been flagged before for saying those names. I ain't even gonna say it. You feel me? They might even jack me up for even saying something about that instance. They real, they real tough, man. TikTok real tough. Yeah. Hit the link in the bio though, for sure. Hit the link in the bio. But now, what was I saying? I can't read the questions for y'all for a second because I'm focused on trying to remember everything. I'm a little fried. I apologize, but I got to remember everything that I had to talk about. I need to just start writing this shit down. Yeah, that's what I should do. But y'all know me. I like the freestyle. I like the freestyle. But anyways, so y'all can borrow money more. That's where I was at. Yeah. So that supports spending, housing, and just overall demand. Now, whenever they cut rates during bad times, when we need that extra boost, they cut the rates. But in this special situation, the market is already fucking doing well. So companies are already profitable. Consumers are already spending. And the economy has momentum. So the Fed cutting rates is like pouring gasoline on an already fire burning. You understand? That makes sense? I told y'all I'm going somewhere with this shit tonight. We got some shit to talk about tonight because this was actually an interesting week and a lot of people was calling it a big old nothing burger, but I disagree. It was not a nothing burger. Real investors recognize what's going on right now. They see the Fed's cut not as desperation, but as support. So when the confidence is high, valuations expand. All right. So what I'm saying is people are willing to pay higher multiples for earnings because they see lower interest rates, stable growth, and more liquidity. They comfortable. So this is why the stocks don't just hold steady. They often accelerate higher. This is why it ain't going to trade sideways. It ain't going to drop right now. And this is not financial advice. And of course, I don't fucking got a crystal ball, but I kind of do. My crystal ball tells me everything that has happened and everything that will happen and can happen and shall happen in Murphy Law face okay? But think of it like a runner in a race. The runner is already sprinting hard as fuck. He leading the pack. Now, if you hand that runner an energy drink halfway through that shit, or give him a line or something, if you know what I'm talking about. I don't know what the hell. You give him something, right? What you think he gonna do? No, they not gonna slow down. You just gave him a booster. They're going to explode forward. And that's what Fed cuts near highs do to the market. You done gave the market. It's like giving a sprinter a booster, a roids. And now it's going to go even more. Right. Powder NOS. Turbo. Y'all with me so far? Now, I don't want to point this as a picture perfect, no risk scenario. You feel me? I don't want y'all talking about, you said blue, 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 blah, blah, blue, blah. Is that a tank top or listen? I don't want y'all thinking I said that, because if you look at the 6-month charts, if you look at the 6-month returns, let me pull this chart back up. Hold on. Hold up. My phone on 20%. I need to, hold on. I need to get my pictures together. It's okay, but check it out. Check it out. If you look at the 6 months returns, this is definitely not it. Yeah, this is it right here. Next 6 months. All right. So if you look at the 6 months returns, there are definitely some red numbers. But in 1986, we saw a negative return over 6 months. Hold on. Portable fast charger. I got a charger. I just need to plug it up. 1 second. It's so tedious. I'm one of them people. I let my shit get down. I will let my shit get down to 1%. Okay, anyways, what was I saying? So look, y'all see some red days. And for those that don't know, I'm pretty sure you can zoom in. You can take your fingers and zoom in, if I'm not mistaken. I'm sorry for it being so small. Don't blame me. Blame TikTok. But look, there are some red numbers. All right, and we do see that sometimes there was a negative return over 6 months. But in 1989, again, the 6-month return was negative. In 2019, one of the Fed cuts led to a pretty sharp short-term drop. Like, what's happening there? The markets don't move in straight lines, bro. Even in bullish environments, you get pullbacks. I'm gonna give y'all all my thoughts. I'm gonna answer the questions and all that, y'all. Just please, if you can hold all your questions to the end of the show, I will highly appreciate it. And I will answer your question as long as you follow me. If you haven't pressed follow yet, then I'm gonna look at your question like it don't exist. Just keeping it a buck with you. But yeah, other than that, I got y'all. I will answer all the questions at the end of the show. Please hold your questions to the end of the show. Thank you. I'm just playing. Y'all can ask them all you want, really, to be honest with you, because you might forget that shit by the end. So ask it, and then I might have you ask it again. You feel me? I ain't going to tell y'all not to do that. That sounds crazy as hell. Please give me 1,000 pardons, y'all. 1,000 pardons. Can't zoom in, guys, but the screenshot and listen to the insights and then view the chart after the session. Okay, so I didn't know they couldn't zoom in. I could have swore, because I be zooming in on people's shit all the time, Melody. So when I'm on somebody live, like, I can zoom in on. I didn't even know it until here recently, but it's okay. I apologize for it. But you can also Google this information. It's not hard to find. You can Google this information for sure. For sure. Yeah, like I said, even in bullish environments, you get pullbacks, consolidations, and corrections. So sometimes the Fed cuts and the market pullbacks or pulls back because traders think, wait, does the Fed see something bad that we don't see? You see what I'm saying? Like, a lot of time, that's how we thinking. That's how we looking at shit. Like, we thinking that they see something that we don't see. You feel me? Lencho says he can zoom. Yeah, they probably need to update their app, but it's okay. It's no problem. I'll just try to make sure I do better with the cropping of the photos, because every time I have something to show you guys, it always gets like, man, TikTok just butchers the hell out of it. But anyways, people think that the Fed see something that we don't see, or sometimes it's just normal profit taking. Like, sometimes people just taking profit. But this is the key point. Those dips were temporary dips, man. Ladies and gentlemen, those were temporary dips. They didn't change the 1-year outcome. Every single time, like, once you zoom out to the 12-month view and get a better look at what happened that year, like I always tell y'all, when in doubt, zoom the fuck out. The market had pushed higher, like, once you really get a look at it. So the lesson is clear. Don't let a short-term wobble, right? Don't let a short-term wobble convince you the long-term pattern is broken. Short-term volatility is just fucking noise. The signal is the 1 year track record. You want to look at what that shit did over the year. And it's been perfect. It's been perfect. Make it make sense, y'all. Make it make sense. So in today's context, we can bring this to the present day since we've been talking about the past and shit. The Fed cut rates in September 2024 last year, and again in November. They cut rates back then in September and November, right as the S&P 500 was sitting there an all-time high. That puts us exactly in this historical setup. So the question is, will 2025 follow the same script as the past 40 years? If history rhymes, then yes, we should expect higher stock prices over the next 12 months. And of course, every cycle is different, right? We got unique shit going on today that wasn't going on then, maybe, right? Inflation dynamics, we got global tensions and shit, new technologies like AI that's reshaping productivity, and then Trump and all this extra shit. But remember, like, the past cycles had their own unique challenges too. That's what I'm saying. They had different shit going on too. The 1980s had inflation then too. Inflation ain't new. They had inflation and they was dealing with fucking the Cold War. 1990s had the Gulf War and the tech bubble fears and shit. 2010, they was dealing with technology in a bubble back then. So shut the fuck up with that technologies in the bubble shit. And I'm gonna shut up with it too, cause like literally they've been scared of this technology, but and it ain't been no bubble. It then grew more than what they thought it was gonna grow. All right, the 2010s had the European debt crisis and trade wars, and despite those headwinds and shit that was going on then, the historical pattern still held. So if you're looking for a roadmap, history says 2025 could be another strong year for stocks, especially if the Fed is cutting proactively rather than reactively. And by the way, sectors like technology and growth stocks often benefit the most in these type of situations and scenarios because they can thrive on lower borrowing cost and higher risk appetite. So financials can also benefit once the curve steepen, but you know, I mean, in cyclical sectors like industries and consumer discretionary tend to do well whenever a lot of liquidity flow into the economy too. So we looking at a lot of money that's gonna come into this shit just cause they doing good, just cause technology is doing good. They make a lot of money off not borrowing. They borrow a little bit. They don't have to borrow as much. All right, what can we take away from all of this? I know I'm talking a lot, y'all. I'm sorry, but what can we take away from all of this? It matters. First, understand that history is not a fucking guarantee. I'm not guaranteeing nothing. I'm not guaranteeing anything, okay? History is not a guarantee. It's not. But it is a powerful guide, though. It is a powerful guide. When you have 100% track record over 18 instances spanning 40 years, that's something you don't want to ignore. And then second of all, don't let the short-term shit shake you out. I keep telling y'all, can you not see so far ahead? Y'all know I start singing at this time of night and shit. Don't let that short-term volatility shake you out. If you see a dip in the next 3 months, remember that the 6-month window isn't always positive, but zoom out to a year and the odds shift dramatically in your favor. When in doubt, zoom the fuck out. So third, if you a long-term investor, this is the kind of environment where patience pays. The setup we in right now has historically been bullish. Thank y'all for the likes. I appreciate it. Thank you. Thank you for the likes. And if you are new to the channel, new to the page, go ahead and hit the follow button. Hit the follow button. You don't want to miss these type of lives. I'm coming with this type of energy, usually more than likely, but tonight I figured I'd give y'all some historical data. Some historical data. I done did my research. How do I learn to chart as a beginner? You follow me. I got you, Albert. To keep it 1,000 with you, Albert, it's all public information, and you can go and look this stuff up on your own time, but I can just walk you through and guide you through, and I can be your mentor, but there is nothing you can't go and learn right now in 2025. You can go and look up everything there is to learn about trading on the internet for free. You can read, watch videos, You know, all of that. I got you, JoJo. You wasn't here. I ain't done, JoJo, with my presentation. Hold your question to the end of the show. Y'all know JoJo the one that taught me that. JoJo the one taught me to hold my tell y'all to hold y'all questions to the end of the show. And you gonna ask me that, but I got you, JoJo. I was looking at Reker, REKR. This is on my radar, and I also was telling them about well, you don't trade options, but this one. This one is looking good because it's an inverse head and shoulders pattern, and that's a pretty easy trade to take. Not to mention, I'm already bullish on ELF. They ain't have to be in no inverse head and shoulders pattern. It could have been in a bearish continuation pattern. I still would buy, especially at the end of the bearish continuation pattern, because I can get it for cheaper. But what I'm saying is this is about to take off. Those are my trades for tomorrow. But, you know, there's other things as well. I just wanted to kind of like get through this. I'm not done with the historical data. For the history data, is it usually around the same time or same time of the year every time? That is a good question. Good question. I'm about to get to that. That's why I was telling them I'm just getting started for real. I'm just getting started. We're gonna talk about it. Fuck it. Let's talk about it. Let's dive deep real quick. We're gonna dive a little deeper. July 25th. Let's take y'all back to 1980 looking at the first case, right? All right, this is the first case in this chart right here. You can't really see the dates, but that first date is 1980. I'm going to call the dates out, and y'all just going to have to realize which one I'm talking about. So, 1980. The U.S. was battling stagflation. Y'all know what stagflation is? High inflation and weak growth. Stagflation, that's a new word. All right, for some of y'all never heard of stagflation, do your research. Paul Volcker, some motherfucker named Paul Volcker was the Fed chair. And not Jerome Powell, but he was just as annoying if you ask me. But I don't know because I wasn't born back then. I just kind of watched some videos and did some research. But the interest rates was swinging wild as fuck back then. They was freaking out back then too. Inflation had peaked at over 14% at that time. Fed cut rates briefly to relieve the pressure. So the S&P was only 0.59. That's why I say negative 0.59. It was only 0.59% below an all-time high at that time. 6 months later, 7% return. One year later, 7% return. So even in one of the toughest inflationary periods in the U.S. history, when the Fed made a cut in their market highs, the market still pushed higher over the next year. The next one on the list, this is January 11th, January 11th, 1983. 1983. The U.S. had just came out of a brutal double dip recession. Help me out, JoJo. I know your ass remember. That's around your time. And some of y'all too. Some of y'all know what else? The baby boomers is about to be, I think they asses is, I ain't saying you a baby boomer, JoJo. You like 30 years old, right? I'm just playing, JoJo. Listen, the baby boomers is like 60 right now. I think they like 60. And a lot of them trying to figure out, let me not get off topic. Yo, you talking about you Gen X. Okay. I'm Gen X too. Yeah, where was I at? January 11th. I can't get sidetracked because then I start cracking jokes and singing songs and shit. It'll turn into a shit show. So yeah, they just got out of a double dip recession back then. I know I'm not. I was just talking shit. I'm a 90s baby. Born in 91. All right, so look, we just came out of a double dip recession in the 80s, though, like in 1983. Inflation was cooling down. This is 3 years after 1980, of course. Inflation was cooling down. Unemployment was high, but improving. I'm a millennial. That's what we call millennials. Okay. I don't know why, but I don't know why, but I don't like that. And then when I think of that shit, all I could think of Bicentennial Man with Robin Williams. That's all I could think of for some reason. Like, anyways, don't get me sidetracked. So the Fed began cutting rates that year, and as a part of them trying to ease that cycle. And right at an all-time high was what the market was. 6 months later, guess what? You see 13%. Y'all see the second one on this chart? 13%. 6 months later, the market was up 13%. 1 year later, 15%. So this was the early Reagan era recovery. Some of y'all got a chance to see Ronald Reagan in action. This was during that time. The market was hitting records. The Fed eased, and investors who stayed long, they rode a powerful rally. Number 3 on this chart, February 28th, 1983. Let me see, what happened back then? I don't fucking know. The economy was gaining traction. We already talked about January 83, February 28th, 1983. We just gonna go ahead and skip because the Feds doubled down on cuts in early 83. Again, the market responded positively because they cut it twice. That's why it's 2 dates for 1983, because it's two different, they cut it twice. But 1985, they got another cut. The dollar was extremely strong in 1985, and this was hurting exports, though. The Fed cut, they needed that to happen to stabilize growth at the time. And so the market was within 1% of a record. It was in 1% of being at an all-time high at that time. 6 months later, 14% return. 1 year later, 21% fucking return. Y'all not hearing me though. I don't think y'all hear me though. So that was in 1985. This cut launched one of the strongest rallies of 1980. It showed that sometimes the Fed support isn't about a fucking crisis. It's about extending expansion. Sometimes when they cut it, it ain't about a crisis. It's about growing shit. It ain't all about them trying to make sure we ain't going to the pits of hell. Sometimes they you know, helping us go there face ass. But anyways, again, they cut it again later on in 1985 again. Same year. Back-to-back examples. In 85, multiple cuts happened in a strong economy, and it just reinforced investor confidence. So y'all should be confident now. 1986, though, I ain't done. Look, I got one for every time they ever cut the motherfucking rates on this chart. Every time they ever cut the rates. We got to make it make sense, though. Of course, I got the rest of the years past 2019 too, but we got to make it make sense, though. Let's go to April 21st, 1986. I don't got that on the chart. The Feds eased amid energy weakened. They had weakness in energy during that time. The market was like less than 1% below all-time highs. 1 year later, it was up 16%. So that's a perfect example on that one because the 6 month return was negative. But 1 year later, investors was rewarded with nearly 17% gains. This is why zooming the fuck out matters. August 26, 1986, it happened again. Fast forward, July 31st, 1989, which is also not on this chart. Oh, there it is, 1989. So in 1989, matter of fact, I like the other chart better. I'm sorry. So in 1989, July 31st, we dealing with the pre-Gulf War. I don't know if y'all know about the Gulf Wars and shit, but that was building up. The economy was showing like late cycle signs, but the market was at an all-time high then. 6 months later, it was down 6%. 1 year later, it was up 2%. So not every case was massive gains. This was a late cycle during that year, but the return was like, you know, kind of quieted down, but it still didn't crash. All right, July 13th, 1990. Which one is that? 14, 3.5. 14 right here. It is literally 1, 2, 3. It's the fourth one. The one that says negative 1.24. I know y'all can't zoom in, but here's the date right here. July 13th, 1990. It says negative 14%. Yeah. So this is just before the Gulf War. Recession fears was rising. The market was less than 1% below all-time highs. Guess what? 6 months later, it was down fucking 14%. 1 year later, up 3%. This was one of the few scary ones because the market had dropped right after the cut. But once again, zoom out to the 12-month and the S&P still ended higher. Now, the year I was born, but I wasn't born yet. It was March 8th. I was born later on that year. But 1991, the U.S. had just came out of the 1991 recession. That was triggered partly by the Gulf War and then oil. Everybody couldn't shut the fuck up about oil. And then the prices of oil was rising back then. By early 1991, Operation Desert Storm had just been wrapped up. I think this was dealing with Bush back then. Consumer confidence was improving at that time. The economy was stabilizing. The market was about less than 1%, close to being at an all-time high. This shit is not new. There ain't nothing new under the sun. Like I just find it funny that we are literally in the same spot we always are in historically, less than 1% or 1% close to all-time highs when the cut happened. Almost like it's planned. So yeah, during that time, 1991, within 1% of an all-time high, 0.41% to be exact. 6 months later, the market was up 4%. 1 year later, 8%. This was the beginning of the roaring 1990s bull market. There was a bull market that happened in the 90s, if y'all don't know. The Fed's cut gave extra juice just as the economy was stabilizing. Somebody said also when Donald Trump is in office, stocks are bullish. Yeah, it do feel like that. But investors who stayed in back then, they got rewarded as the longest bull run of the 20th century unfolded. 1991. That was the beginning of the roaring 1990s bull market. Literally. This shit was, they still consider it to be one of the longest bull runs of the 20th century. 1991, later on that year, the Soviet Union, I don't even like saying that word. The Soviet Union was collapsing. Big geopolitical uncertainty, but the U.S. economy was healing. It was licking its wounds at the time. And the Fed cut again to ensure momentum stayed strong. The market was within 1% of all-time highs. Y'all notice this. Y'all don't see the pattern yet. I done already went down this shit about 9 to 10 times, and each time the market was within 1% of all-time highs. 6 months later, 1991, it was up 6%. 1 year later, up 8%. So even during one of the most uncertain times in global politics, the fall of the Soviet fucking Union, the S&P still pushed higher. I'm not done. Wait, there's more. The Fed, like 1991, a day after my birthday, October 31st, 1991. Halloween cut. That's what that year was called, the Halloween cut. We got a cut on Halloween that year. The market was consolidating after a strong run, so it had just went up a lot, and now it was calming down. The Feds wanted to keep financial conditions loose. Guess where the market was? Close. Guess how close it was to all-time highs? Within 1%, like the last 10 times. Over the last 10 years I done named. Guess what it was 6 months later? Up 5%. Guess what it was 1 year later? Up 7%. That's another steady step higher. Not a blowout rally, but consistent gains. So that fits the theme. Short-term positive, long-term solid. Somebody say September 18th about to go crazy, chat. Really, I thought they just went crazy yesterday. They already went crazy. I think it's all priced in, Lencho. It's priced in. Today, they thought that today was going to be a very bullish day for the S&P, but it didn't turn out that way, though, did it? We had a strong dip. As soon as he started talking, it went down. Went down to about $650-some, $655, I think. Yeah, as soon as he started talking, it went down instead of going up. But that's very small thinking. We just think about today. We talking about zooming out and getting a better picture of what has happened historically speaking. You feel me? So that was another steady step up higher back in 91. All right. Fast forward, 92, the U.S. was entering into the Clinton era. All right. Put a W in the chat if you remember Bill Clinton. I don't know if y'all remember. I was a child. I grew up in, I want to say poverty. I remember paper food stamps. My mama used to send me to the store, right, during this time when Clinton was in office to get to get some stuff from the store with paper food stamps. I remember that shit like it was nothing. I remember them was some good times when he was in office, when Bill Clinton was in office. I don't know nothing about none of that Monica Lewinsky shit. Yep, it was my aunt. Yeah. So yeah, the US was entering, they was getting ready to go into that era. The 1990s tech the boom was just beginning. So we still in that technology boom that started in the 90s. That's why us millennials got this shit figured out so good, because we was born right at the boom. You know, the 80s babies, y'all had some technology, cool. The 70s babies, you feel me? In the 60s, but they look. My grandma was born in the 50s and she on Facebook, man, playing AI games and shit. So don't get it twisted. You feel me? Don't get it twisted. But that's off topic. 1992, we enter in the Clinton era. The 90s tech boom was just beginning. The Fed cut rates to extend the recovery momentum. So we was a little bit higher than 1% during that time, but we was below all-time highs. Let me see, just to be for sure. What day did I say? July 2nd, 1992. Yeah, it's right there. We was under all-time highs, but 6 months later, up 5%. 1 year later, up 9%. The early 90s recovery mode. All right, that's what it was. Investors who stayed patient was rewarded as the tech-led bull market accelerated in the years ahead. So there was a bull market that was led by all the technology, and it just kept going up after that. Later on that year, it happened again, back-to-back cuts in 1992. So this shit kept going higher. The S&P kept going higher. It shows you how persistent easing creates a tailwind for equities. Persistent easing creates a tailwind for equity. So if this shit go up a little bit by a little bit, it's gonna make it go up a lot. It's tailwind. All right, 1995, 3 years later, July 6th, mid-90s. I'm 4 years old at the time. Strong economy. Productivity gains and tech innovation beginning to kick in. The Fed cut to fine-tune, not to rescue. They cut rates back then to fine-tune, not to rescue the market. Someone say, I always use the 70s for a reference point. Stagflation, there go that word again, is a real silent disruptor no one is talking about. House of Investing. Ironworth Trading talking about it. Ironworth Trading is talking about it. I talked about it tonight. I think I told them to go check out the word stagflation, because July 25th, 1980, that's the first case in this chart that you're looking at. The U.S. was battling stagflation back then. So even in one of the toughest inflationary periods in the U.S. history, the Feds made a cut near market highs, just like they did now, and the market still pushed higher over the next year. So we pretty much talking about that now, because I like to pay attention to patterns. I love paying attention to patterns. So yeah, 1995, July the 6th, we after we literally was below all-time highs that year when the rate cut happened, but 6 months later we was up 11%. 1 year later, up 21%. Jeez Louise, hold on. Let me find my they need to put my soundboard. Or maybe I need to get a external soundboard. That's what I need to do, because I don't like having to hunt for these sound effects that they have, right? I want my sound effects to be right here in front of me. All right, like I said, the economy was dealing with like the .com boom. I don't know if y'all know about that, but that 20% return, 20% return is crazy. Now that's huge. The mid-90s was the liftoff point for the .com boom. Like the Fed cut right before one of the strongest multi-year bull runs in fucking history. July 31st. No, not July, January 31st. It's so hard to see. I'm sorry, y'all. Stocks versus real estate, which gave most returns? Well, in the 90s, this is coming right before the 2000s. So back then, man, if you could have got in the housing market, if you could have gotten the real estate back then and you still in it now, you should be straight. I don't even, I don't even think we got no viewers in here tonight that did. Because I don't see why they would even be listening to little old me. They should be swimming in millions by now. Millions, I tell you. Anyways, so if you've ever heard the phrase irrational exuberance from the Fed chair Alan Greenspan, that was the era. But again, they cut rates near all-time highs. 1 year later, boom, up over 20 fucking percent. Fast forward 2000, I'm gonna go all the way to 2019. Fast forward to modern times, because I know I don't want to just cut. I know y'all probably tired of me talking, right? It's cool though. I ain't done. Like I said, but wait, there's more. Fast forward, July 31st, 2019. We're gonna go to modern times. They had a trade war around that time with China, just like we kind of do now. But back then it was rattling people's confidence, and the global growth was slowing down at that time. Because remember, we was just coming out of the boom. Jose invites you to co-host. I don't know who Jose is. Anyways, so the Feds cut the rates back then in that year to calm the markets. Every time I'm gonna tell y'all, I'm giving y'all the same setup. The market setup during that time was less than 1% below all-time highs. 6 months later, the market was up 10%. 1 year later, the market was up 8%. Even in the middle of a messy trade war, the market pushed higher. That shows the resilience of the Feds cutting the rates near the high pattern. I done gave y'all this pattern. If y'all don't see the pattern by now, I got more. October 30th, 2019, they cut that shit again. This is pre-COVID. Pre-COVID. When they cut the rates that year, we was a little bit under all-time highs, the same way we a little bit under all-time highs now. Now, within 6 months, the market dropped 7% more. And then after a year, it was up 8%. So that captures the COVID shock perfectly. Short-term collapse, but long-term, the Fed's liquidity drive brought markets back to an all-time high within months. 2024, they cut it again. Inflation cooled significantly. The economy was still strong. Unemployment was low. AI boom was fueling optimism at that time. Like literally just last year, we was talking about AI a lot. The market was down a little bit under 1%. 6 months later, it was up a little bit less than 1%. And 1 year later is today, pretty much. So we are living this one right now, but the market barely dipped. History suggests that looking out into 2025, the odds are heavily favoring towards another strong leg higher. The freshest example is last year, in November. A slight ass dip in the short term, but history suggests that like the real story gonna be told later on this year. If the past 40 years it was like a tour guide, we could see meaningful gains over the next 12 months. But look, we're gonna flip the script for a second. Cause I know y'all like he didn't talk about this shit like he just know a bull run on the way. You feel me? We gotta, like I said, we went over plan A. Plan A is 40 times. I mean, the past 40 years, this didn't happen. So, I mean, why the fuck wouldn't it? Like I said, you flip the coin 18 times and it land on heads 18 times. The 19th time, I'm going to assume it's just going to land on heads. I done been wrong 18 times thinking it was going to be tails. Hell, after the third time, you would have had me guessing it was going to be tails. But anyways, we're going to give you the plan B. We're going to flip the script for a moment. Because we've been talking about how every single time the Fed cut rates near market highs, the S&P 500 was higher 1 year later. That's the bullish case. But of course, no bull market lasts forever. So the logical question is, when could the crash happen? When does history say this pattern breaks down? Here's the truth. The markets don't usually crash right after the Feds cut near all-time highs, man. Do y'all hear me? It don't usually happen. In fact, the crashes tend to come later. Usually, once the Fed has cut the rates too fucking much, or inflation start heating up again, or something break in the financial system. So let's look at history. 1987, the market had one of the biggest single-day crashes ever. Black Monday. There is a movie. There's a movie out. It's actually a TV show with Don Cheadle. With Don Cheadle and Regina King. It's called Black Monday. It is hilarious. It is stock market related. I think y'all will find it entertaining. It's hilarious. It's a bit extreme. It is a bit extreme, a bit exaggerative, but I think it's entertaining as fuck. It's called Black Monday, and it's starring Regina King and Don Cheadle. It's hilarious. Anyways, in 1987, the market had one of the biggest single day crashes ever. Black Monday. Guess what? Uh-oh. Well, I thought TikTok was getting me because something popped up on the screen like, damn, is they about to get me for recommending the movie? Anyways, guess what happened after Black Monday? That wasn't right after the Fed cut near all-time highs. That was triggered by leverage, portfolio insurance, and an external shock, some shit that happened on the outside. In the 2000 dot-com bubble, the crash didn't come when the Fed was cutting rates near highs. The crash came after years of excess speculation. They just was looking. They was looking, don't know what the fuck they talking about. Was just looking what they looking as, and was looking a little bit too much. When valuations just couldn't be justified anymore, they just was guessing. I think they was guessing in the during that dot-com bubble. You feel me? Don't get me started. Anyways, in 2008, the financial crisis hit after years of housing leverage. Go watch a movie called The Big Short. Go watch a movie called The Big Short. If you've already seen it, put a W in the chat. If you haven't, go check out The Big Short. It's a good movie. Good movie to watch that'll teach you about what happened in 2008 during the financial crisis that hit after years of housing leverage. They was giving out housing loans to just about any fucking body. They was letting you get a house loan with a 300 credit score during that time. Don't believe me? Go look it up. I'm telling you. And then all I remember during that time was I think I was like I definitely was in school. I remember Young Jeezy album. He had a song out called "My President Is Black, My Lambo's Blue, and I don't give a some shit like that." And I know that he had an album called The Recession. So that's how I bookmarked 2008, because I didn't know shit for real about the stock market. But I do remember Jeezy saying we was in a recession, but I didn't know what the fuck a recession was, because all my life we was in a recession. We grew up in a recession. Recession ain't never scared us. Y'all know who I'm talking about. And it ain't got nothing to do with skin color. I'm talking about, sometimes kinfolk ain't skin folk. All skin folk ain't kinfolk. I'm talking about poor people. We grew up poor. We grew up in the same zip code. We grew up poor. And there was people of all skin tones in the neighborhood. You had poor Indians, poor Chinese people, poor white people, poor black people. And out of those 4 people, only 2 of them named after crayon colors. So I'm just going to say poor Americans. Now, in 2020, well, I didn't really go over 2008. When the Feds cut during when that happened, it wasn't because, like, when that crash happened in 2008 and that recession and shit happened after the housing market, it wasn't because the Feds cut the rates. It was caused by that bubble breaking. And then in 2020, COVID was the shock. Markets crashed 35% in weeks. But 1 year later, the market was way higher again, and that was because of Fed support. So what does this tell us? It tells us that crashes usually happen because of external shocks or bubbles bursting, not because the Feds cut rates while the market was near an all-time high. If you made it this far in the live, you are a champion. You understand me? And I'm pretty sure you're going to make a lot of fucking money in the coming days or the coming months or in the coming years, because you made it this far. You paid attention. Now, we could see a crash in the near future. Could we? Yeah, it's possible. But, like, so what could bring a crash? Inflation could flare up again, forcing the Feds to reverse the course and bring this shit right back up. We got geopolitical risk. There could be another war. Hell, we just ended a war, a so-called 12-day war. Trade conflicts, we dealing with those all the time. Global instability, we got that threatening us all the time and shit too. Let me see. 27. Yeah, I know it's 3 o'clock in the morning. People going to bed. Unemployment and tariffs. It's a lot of stuff that could bring it down. A lot of stuff. Tech stocks are expensive. If earnings don't keep up, and they already threatening to take that away, we could see a sharp correction. So the U.S. government's debt load is massive too, and higher refinancing costs could make the market crash as well. But here's the key. History shows that the crash doesn't usually happen in that first year after the Fed cuts near highs. The first year has been consistently bullish. The danger zone is often later, 2 to 3 years down the line, once the market has gotten too far ahead of itself or something external breaks. So to answer the question directly, yes, a crash will come eventually, but because crashes are like, they're gonna come eventually, but because that's only because crashes are a part of the market, y'all. If history repeats itself, the odds say that the crash won't be right now. In the first 12 months after the Fed's cuts, more likely it comes later. And after this bullish ass cycle that we in is already played out, then you can expect a crash. That's why long-term investors focus on probabilities. The probability right now, based on 40 years of history, is that the market is higher in 2025. The crash conversation, that's probably a 2026 or 2027 problem. And when it comes, it's going to be a problem for sure. You feel me? But when in doubt, zoom the fuck out. Remember, trading is about, investing is about probability. It's not about predictability. All right. So this is just how we look at it. Like I told y'all, 87 was one of the worst one-day percentage drops in U.S. history. There was computerized program trading. They had just started that computerized program trading shit. Portfolio insurance triggered mass automatic selling. They started selling at a high rate. This was algorithms was first started kicking off. The markets was already overheated after a big ass bull run then. So rising interest rates in the months prior to that had shaken up the confidence. But what didn't cause it was the Fed's cutting rates. I sound like a broken record, y'all. I'm gonna stop. I'm pretty much done. That wraps it up for the show. The last big crash we had was the last big ass crash we had was in 2020. The S&P 500 dropped 35% in weeks, the fastest fucking crash in history. It was the global pandemic that caused it though. Like y'all gotta remember, like something has to happen for a crash to really happen like that. And right now nothing is pointing towards it being a bearish market on the way. So I hope y'all enjoyed the show for tonight. That just about sums it up. Any questions? Now we are at the Q&A section of the show. Thank y'all for holding this long. It's only 23 people that made it this far. So yeah, this might be one of my shortest, one of my smallest audiences ever. When I end the live, I get to see the analytics and it shows me how many people joined the show. Oh, good question, Dino. Well, gold, we know gold gonna continue to rise, but what if I told you that silver is going to outperform gold over the next 10 years? Silver is going to outperform gold. Silver has a multi-role use. I don't like Heiken Ashi candles. My thoughts on them are it don't show you. I need to see whenever the market is going down in an uptrend. I like to see whenever the market is going up in a downtrend, and Heiken Ashi candles won't show you that. They've been present, the price of silver. Yeah, man, silver is about to go up, bro, and we have the opportunity, y'all. Listen, there's 22 people in here. I'm going to flip y'all to silver. I don't know what to tell y'all to get y'all to understand that now is the time to buy silver. But I can't stress it enough. I can't fucking stress it enough. Especially all you baby boomers and Gen Xers. Y'all want to retire early? Fucking silver is going to get you there. This is not financial advice. Let me calm down. I got a little carried away. No. You're wrong, water skeeter. You are wrong. You are incorrect. Go do some research though. I ain't gonna argue with you. Don't argue with me. Argue with your neighbor. I ain't gonna say what I wanted to say because my mama passed away last year. But I still be arguing with her too though. So don't argue with me. Argue with your mama. Good. You good. You good. You good, JoJo. Don't, that's what's up. And you probably bought it at a dirt cheap ass price too. You're good. For real. Especially the more it's in electric vehicles, solar panels, etc. And if you think he's saying just because it's in abundance, it's not a good buy, that's not fucking true. You welcome, Limelight. And nothing I said in the live was financial advice. It's all for educational purposes only, and y'all can do y'all research. Don't believe shit I say. Go look it up. I don't believe in nothing. I don't believe shit. I know. I like to tell people I don't believe in God. I know God. It's a difference. Do y'all believe y'all listening to me right now, or do you know you listening to me right now? Right? There's power in belief, sure. But there's power also in knowing. Gotta invest with research and conviction. That's right, Dino. That's right. Y'all know. That's what I'm talking about. So yeah, with that being said, I'm gonna go ahead and call it a night. I appreciate y'all for tuning in. Thank you so much. I'll catch y'all next time in the Ironworth Trading Show. Don't forget to press follow if you haven't already. Check the link in my bio to reach me and connect with me on other levels outside of this. You are welcome. Smile on, sorry. You're welcome. So yeah, that's how I know when fatigue kicking in. Smile on. It's time for me to lay down because the market opened at 9:30 and I got a lot of work to do at 7 a.m. So I'm only gonna get about 4 hours of sleep. 3 hours of sleep. Shit. I'ma holler at y'all. Good night. Thank you, Melody and JoJo, for helping me moderate the show tonight. Rest up. Good night. Yes, thank you for helping me. You're right. We're gonna get to 20K. Y'all help me get to 20K before I close the live, please. Thank you. Y'all been a wonderful audience. I actually forgot to go over the stocks that I'm looking at. Bullish, Atlas Clear, JoJo. Atlas Clear. It just did some crazy shit. I'm not sure how much more of that stock can go, but add it to your watch list. I think, you know what I'm saying. I don't want to say too much, but add it to your watch list. All of these are actually good, but I know you like shit that's under $1. You know what I'm saying? Or under $2, under $5. You like stuff like that. Atlas Clear is a good one to check out. I like Rigetti right now. You got in at 96 cents, Melody. That's awesome. Somebody asked me if I like Grab. I do. I like Big Bear as well. You feel me? But all of these companies just flip bearish on the short term. I know y'all like the right now money. 5-9. I don't know nothing about 5-9, Dino. You be putting me on. Dino, hit me up outside my live shows, buddy. Reach out to me during the day so I can make some shit happen with some of these picks you be having. I check them out during the day. Yeah, Oris. This is a high risk conviction play right here. High risk, high reward. When I say high risk, I don't want to say gambling because I hate using that word. But boy, don't over leverage on this one. But if this plays out like I'm thinking it's gonna play out, yeah, buddy. This could be a good one. And it's going to be short term too. It's like get in and get out at like 50 cents because I don't really know how high it could go or how low it could and how much low it want to come back down. But this, I don't want to get G-Waved. If y'all remember what happened to me with fucking G-Wave, I got kind of bullish with that company. I got carried away and I learned my lesson. Never get too fucking bullish with a company, especially when they trading under 25 cents a share. It's way too close to being delisted. 13 cents is way too close to being delisted, but add it to your watch list. Thank y'all for helping me get to 20,000 likes. Thank you so much, Constance. Thank you so much, Melody. Thank you so much, JoJo. Thank you so much, Dino. Y'all are in my MVPs and everyone else. Thank y'all. I'm about to get up out of here because y'all know I will talk y'all to death. Y'all know that. I think I went over everything. I'll talk about the rest of tomorrow. I'll talk about a few more things. I never got to go over the power of WIC rejections. That was one of the topics I wanted to go over. So come join the live tomorrow, you guys. Good night.